Buying a home is the largest purchase most people will ever make. It's also an important investment that can have a significant impact on your net worth over time. When buying a home, there's a lot to learn and consider, so I've decided to break this topic into several videos to keep each one to a more manageable size. Today's video is everything you need to know to start the home buying process. Before you start looking for properties, it's worth asking the question, is now the right time for you to buy? There are a wide variety of factors to consider in answering this question, which I've broken down into two general categories: market factors and individual factors. Let's talk about the market factors first. An important factor that you have no control over is whether the area you're buying in is booming or busting. It can be very frustrating to be saving for a home while watching average home prices in your area grow further and further out of your reach. Here's a graph of the inflation-adjusted U.S. Housing Price Index, which tracks the average single-family home price over the last 100 years. You can see this looks a lot like a stock chart with peaks and valleys, but a general trend upwards over time. Just like a stock, you want to buy a house when the price is low and sell when the price is high, but there's no way to predict the future. Also like a stock, because of the long-term upward trend, the longer you plan to keep the house, the more likely it is that you'll make money when you eventually sell it. As a result, the longer you plan to keep the home, the less current market price matters for investment purposes. But if you're planning to own a home for less than 5 years, I highly recommend renting unless you can get an amazing price or you run a big risk of losing money. Remember that you'll be paying closing costs to buy a home and realtor fees to sell a home, so even if the property value goes up, you can still lose money. Another market factor to consider is mortgage rates. Mortgage rates determine how much interest the bank charges on your mortgage loan, which can make a big difference in your monthly payment. Here's a graph of the average 30-year fixed mortgage rate in the US over the last 50 years. As you can see, mortgage rates have been on a steady decline for the last 40 years, but it's very possible we'll return to double-digit mortgage rates if inflation increases. Let's look at an example of how much mortgage rates can affect your monthly payment. If you have a $100,000 mortgage at 5%, your monthly payment would be $537. If mortgage rates were 10%, that same $100,000 mortgage would cost you $878 per month, which is a 64% increase. So for every $100,000 in your mortgage loan, at 10%, you'd be paying $341 per month more than you'd be paying at 5%. Hopefully mortgage rates continue to stay at record lows, but be sure to check where they're at when you start looking for a home. One of the first individual factors you should consider is, are you ready for the responsibility of owning a home? If you're renting, you may be used to calling the landlord when something breaks. Or maybe you're in an apartment where the shrubs and grass and the common areas are maintained by the building owners. As a homeowner, you'll suddenly become responsible for fixing and maintaining everything. That's a big financial commitment, but also a big time commitment that you shouldn't underestimate. Think of owning a home as similar to getting a dog, but instead of daily walks and expensive vet visits, you'll have daily maintenance tasks and expensive roof repairs. It's important to consider the cost of home insurance, maintaining the yard, repainting, power washing the exterior and driveway, homeowners association fees, property taxes, AC, roof, appliance, foundation repairs, and many other things. For budgeting purposes, I generally estimate I'll spend about 2% of the home's value per year in maintenance costs. But maintenance items are a bit unpredictable, so some years you'll spend way less, and other years it will be way more. But 2% is a reasonable average for budgeting purposes. Don't feel bad if you aren't ready to sign up for that kind of responsibility. Another individual factor to consider is job security. I bought a home in 2009 with the expectation that I'd be there 5 to 10 years. 1 year later, I lost my job and spent 10 months looking for work in the small town we were living in. In 2011, I finally found a job in a new city, which meant we ended up selling the house a lot sooner than we expected. We lost not only the $20,000 down payment, but we also had to write a check for another $20,000 at closing because house prices had declined 25% over those 2 years. It was a good lesson about the risk of buying when prices are high and of the importance of considering job security when buying a home. Another individual factor to consider when buying a home is how well it will fit your future needs. You may be expecting to stay in a place for 5 to 10 years, but if you expect to get married, have children, or make other large life changes during that time period, then you should consider those in your home buying decision. In some cases, it may be better to wait and continue to save until you see what your new needs will be. In other cases, if you can afford it, you may choose to buy something larger in preparation for those expected changes. Now that you've thought through all these factors, let's assume you've decided that now is the right time for home ownership. What's next in the process? Before you spend too much time looking at houses online or finding a real estate agent, you need to know if you can get a mortgage loan. A mortgage loan is a loan used to purchase a home where the home is used as collateral to secure the loan. That means that if you're unable to make payments on the loan, the bank will take possession of the home to cover the debt. How large of a mortgage loan you can get will be heavily dependent on your credit score, but will help you determine your price range. You have two options to start this process: pre-qualification and pre-approval. Typical practices will vary based on your location and which lenders you speak to, but generally, if you're still saving up or repairing your credit and just want to start to see what's available, you should start with a pre-qualification. A pre-qualification is really a marketing ploy from banks to help them find people who might be future borrowers but aren't willing to go through the full process of pre-approval yet. In a pre-qualification, the lender asks you to self-report your financial information and will then tell you how much they would loan to you. The key here is that they don't actually pull a hard inquiry on your credit report or officially evaluate you. Here's a link to my credit score video if you want to learn more about that. You'll be asked to provide your credit score, household income, employment status, size of down payment you plan to make, and various other pieces of information. Just keep in mind these pre-qualifications are based on the information you provide and do not guarantee you'll actually be approved for a loan when they run a full process. Your other option, if you're ready to start house shopping immediately, is a pre-approval. This is the first major step in the home buying process. Pre-approval is often a full loan application, which means you'll provide detailed supporting documentation. In the end, you'll get an official letter from the lender committing to a loan amount and interest rate that's good for 60 to 90 days. With the typical closing process taking 30 to 45 days, that means you have 15 to 60 days to find a home and enter a contract if you want to close before your pre-approval expires. That short time window is why lenders won't want to start pre-approval until you're ready to start looking seriously. For documentation, you'll be asked to provide proof for 4 categories of information. Proof of income, like W-2s and 1099s. Proof of assets, including any bank or brokerage account statements for the last 60 days. Proof of debts, which will likely come directly from your credit report to find out how much you owe on any loans, credit cards, or other debts. And finally, proof of rent payment. If you've been renting, you'll need to show payments for the last 12 months and provide landlord contact info for the last 2 years. Expect the pre-approval process to take about a week once you've submitted all the documentation. Your pre-approval letter will make it easier to find a realtor willing to work with you since it shows you're serious about a home purchase. In addition, many sellers won't even consider an offer from a buyer unless you have a pre-approval letter. While applying for mortgage loans, you'll see a lot of different types, which can be a little overwhelming. One of the most common designations you'll see is fixed rate versus ARM. ARM stands for Adjustable Rate Mortgage. A fixed rate will have a single rate for the entire duration of the mortgage, so your monthly payments will never change. An ARM will go up and down based on market interest rates, so your monthly payments could change significantly. ARMs tend to have a slightly lower monthly payment at first for the same size loan because the buyer is taking the long-term risk of market rate fluctuations. The vast majority of buyers choose fixed rate mortgages, especially with the low interest rates today. If you're considering an ARM, be sure to check the adjustment period, which will tell you how often your monthly payments will change. I advise against ARMs in most scenarios because it's adding unnecessary interest rate risk to your investment. Exposing yourself to a ballooning mortgage payment is unwise unless you have the cash on hand to pay it off immediately if interest rates rise. Another element to consider is the duration of the mortgage loan. 10, 15, and 30-year mortgages are the most common. The shorter the mortgage, the higher the monthly payment will be, but the less interest you'll pay over the life of the loan since you're paying it off faster. From a financial perspective, the shorter duration mortgages are better if you can afford them, but almost everyone goes with a 30-year mortgage since the mandatory payments are the lowest. Remember that with any mortgage, you can always make extra payments toward the loan if you want to pay it off sooner and therefore reduce the total interest paid over the life of the loan. There are also many categories of loans targeted to different types of home buyers. Here are a few of the most common types. Conventional loans, which are the most common, generally require a credit score of 620 and a down payment of at least 3%, though often 5% plus in practice. FHA loans from the Federal Housing Administration are targeted to people with lower credit scores in the 500s and generally require 3.5% to 10% down payments. VA loans from Veterans Affairs are a great option for active military and veterans since they require no down payment at all. USDA loans also do not require a down payment and are great if you're buying a home in a USDA-eligible rural area and have a credit score of at least 640. I've put a link in the description to a government website that allows you to search an address to see if it's eligible for a USDA loan. An important final note on loan types is applicable to first-time home buyers. If you're a first-time home buyer, make sure to let your lender know that. There are many government programs in place to help first-time home buyers with better rates and lower required down payments. Once you've decided on the type of loan and have your pre-approval, you'll be ready to actually start looking for a place. In the next video, we'll talk about finding the right home for you, what all you should consider, and what tools are available to you. See you next time.